I'm Scarlet. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. America first, no more. U.S. stocks are no longer a sure thing. Europe and emerging markets are seeing inflows and catching a bid. The new face of active. Professor Victor Chow created an algo to identify stocks ripe for a rebound, and now he's got an ETF built around his system. And time for some Joe. Coffee prices try grinding higher to deliver a much-needed caffeine hit to one ETF. Now, whether you embrace or reject ETFs, they're here to stay, and their flows often signal broader trends. Eric Balchunas needs no introduction because he is our go-to guy. So what do you see this week? The risk-on theme continues?
Yes, thank you, Scarlett. Exactly, risk-on continuing. This whole November has just been, I'm going to say it, a regime change. It's been tentative all year, but you can tell investors just getting very excited. The first chart here is equities versus fixed income ETFs. And you can see here's equities, right? And here's fixed income, right? So TLT in particular is dragging down fixed income. Equities being led by both U.S. and international ETFs. Even Japan is in the top 5. So a lot of excitement for equities across the board. That's one. Number 2 is sectors. Sectors is where you tend to see regime changes and changes of mood play out early because a lot of traders use sector ETFs. So here we have tech versus staples. Look at tech flows. Boom, up here. Staples kind of down here. Tech is also being driven by things like the Qs, XLK, the Internet ETF, and tech has obviously had a good month in terms of returns. That's what's really behind a lot of this in the flows. Now let's look at factors. Now, a lot of talk about value versus low vol. Value has had a little bit of a comeback, but it just seems like a big deal because value is always bad. So any little comeback we cheer. Growth is beating value this month also, and the flows are showing it. Here's growth flows, and here's low vol. Low vol had been the trade all year, the perfect trade for a tentative sentiment. But growth is coming back, leading performance. And Scarlett, I think I'm ready to call it a regime change. All the signs point to complete risk on.
All right, we'll see how it shakes out for the rest of the year. In the meantime, let's bring in Justin Castelli. He is founder of RLS Wealth Management. And we want to welcome Carolina Wilson, team leader of EM coverage for Bloomberg News. So Justin, as an advisor, have you been adding risk to your clients' accounts? Are they feeling more bullish on growth?
My clients really aren't talking about being bullish, but I have added more equities. So for a lot of my retirees, I have what I would call a tactical strategy. So I mirror this tactical with their strategic, more buy and hold portfolio. And it's a simple 5-fund, 10-month moving average, and it follows kind of the trend and momentum. And I have to give credit to Meb Faber for his Ivy portfolio because I took that as the blueprint. But as of the beginning of this month, as Eric talked about, the 3 remaining funds that were sitting in the short-term bonds all got moved back in November 1st, which would increase the equity.
All right, we're going to dig into your tactical portfolio a little bit later on, but I want to bring in Carolina first because to get the lay of the land here, more and more there's a view here that the U.S. outperformance over the rest of the world has kind of run its course, and overweight on the U.S. is an incredibly crowded trade heading into 2020. What are some of the big calls on that?
As Eric mentioned, we're definitely seeing a rotation, a strong rotation back into risk, as that safety trade that really reigned among ETF investors is starting to unravel with sort of signs of a rebounding economy. At one point, we had seen good progress with U.S.-China trade talks. You have Morgan Stanley coming out and saying that their preference for non-U.S. equities over U.S. equities is greater than it was before. And if we look at the ETF investor channel, the flows and the cash there is following that sentiment almost exactly. EM ETFs have seen 6 weeks of consecutive inflows. That is the longest streak of inflows since the first quarter. And even more love we're seeing for developed market funds like IEFA and those tracking Europe or Japan.
And Justin, you sent me your tactical ETF portfolio. I love digging through it. You have SPEM as your emerging markets ETF, but I also found it interesting that the tactical portfolio is for the retirees.
Correct.
It's kind of counterintuitive. You'd think that tactical would be trading and more for people who are a little more into the juice. Explain the logic there behind this being for retirees.
So I'm coming to you from the perspective of a financial advisor. So not a trader, not an investor only, and I'm allocating these portfolios to help my clients reach their goals. So for retirees, they tend to be a little bit more, they get a little scared a little bit easier because they're in retirement, their chance to make money is not there anymore. So I really look at the tactical strategy as keeping them in the markets when risk is on, but having a strategy that's not my gut, trying to determine when to move more conservative when things go south. So it will drift the portfolio, and if things would go south like last year at the end of the year, they ended up being closer to a 50% stock, 50% bond allocation, but when everything's going well, it's 70-30. So it's more of a behavioral type of investment approach to help those clients.
And if you pull back up Justin's list of holdings in the tactical portfolio, I also saw Smp Emerging Markets and up there, SPEM. Carolina, you sifted through the 13F filings for some prominent investors, and Bridgewater dumped some emerging markets very recently, just before the recovery in the prices for EM.
That's right. I mean, Q4 has definitely painted a different picture for risk than we saw in the previous quarter. And the best way to sort of measure that big money, those big money bets, is through these 13F filings. And we saw overall hedge fund ownership of EEM drop to its lowest, actually, since 2010. And if we look more specifically and pop the hood, you're right, Bridgewater basically halved its exposure to EEM. Tudor Investments totally cut back on it. But what we're seeing in sort of replacement of that is Bridgewater making some more specific EM single country bets. So putting more money into the Taiwan ETF, into Brazil, into India. It's sort of on a roulette wheel, you know, instead of betting black or red, you have Bridgewater sort of moving their chips onto these specific numbers.
Another fund in there that I got to ask about, it's a fascinating topic, is small cap value. A couple months ago, Michael Burry, famously of The Big Short, came out and said this is the area he likes. A lot of people started, it actually worked for a month, then it kind of flaked out a little bit. Then we had Marianne Bartels come on and say, don't buy this. Small cap value is going to give you head fakes all day long. You like it. Explain the rationale for holding SYLV.
So I like it from a fundamental standpoint in academic research, that there's a lot of evidence that supports small cap will do better over the long run, along with value. And we talked about value versus growth. So we're waiting for value to come back for the long term. But there have been a number of times where value and small cap have underperformed. And I just have it in there from a fundamental belief standpoint, not necessarily that I'm making a bet that small cap value is going to come back. Even if small cap value was overpriced, it would still be in that model because I fundamentally believe in it for the long term.
Now, Michael Burry is someone that came up on Twitter, and Eric is a devoted follower of FinTwit. What do you make of that community, that area of engagement in terms of ideas? Is it a good place for you to test out ideas, or is it some place that you want to avoid because of the group bullying?
It is a great place to test out ideas and a great place to also learn. So I'm actually on a Twitter hiatus. So I gave up Twitter for the month of November just to kind of take a break and get away from it. But the community itself is extremely welcoming and very engaging, and you can approach them. But there's a lot of information from white pages to blog posts. You can reach out to the people writing it to learn from it. So it's an amazing community. I don't know of any other community that you might find on Twitter that could even touch what FinTwit's about.
All right, Justin Costelli, thank you so much. Singing the praises of FinTwit, although he's taking a break. RLS Wealth Management and Bloomberg's Carolina Wilson. Now, coming up, attention all the buy the dip investors out there. Finance professor Victor Chow has figured out what should top your buy list. And one ETF that caught our attention this week, SLQD, the iShares 0 to 5 year investment grade corporate bond ETF. It saw more than $100 million trade on Monday morning. Just 3 minutes earlier, a junk debt ETF strategy printed about the same amount. Coincidence? Probably not. It was the biggest inflow in more than a year. There's been strong investor demand for high quality assets. This is Bloomberg. I'm Scarlet Fu. This is ETF IQ. Let's get you to the ETF life cycle, which has 3 main stages. And step 1 is the filing. BlackRock registers an ESG offering, the iShares ESG MSCI EM Leaders ETF. This fund will be the 4th emerging markets ESG fund on U.S. exchanges and the 2nd of its kind from iShares. Step 2 is the launch. The Smart ETF's Smart Transportation and Technology ETF began trading this week under the ticker MOTO. It provides global exposure to companies shaping the future of transportation. Top holdings include Alphabet, Samsung, and NVIDIA. And for some, the final stage is liquidation. Cushing Asset Management shutting down 4 ETFs launched about a year ago. The funds provided sector exposure for master limited partnerships, focusing on energy, energy supply chain, utilities, and transportation, but investors never bought in. It's time to get passive aggressive, where we track the tensions between active and passive investing. Buying the dip has worked incredibly well during this 10-year bull market. But how do you go about identifying which stocks are ripe for a rebound? Victor Chow, a professor of finance at West Virginia University, created an algorithm to do just that. And that turned into the basis for an ETF, the Vesper U.S. Large Cap Short-Term Reversal Strategy ETF. It's a mouthful. Professor Chow joins us now. Great to see you.
Good to see you.
So in a way, you are the new face of active because you're creating these algorithms, you're parlaying them into indexes, and then they get made into ETFs. Do you see your work as active stock picking?
Well, it is in some sense, all right. The creation of this particular ETF is based on the index. And the index behind that, I create a strategy for investment. And this strategy is based on the behavioral finance aspect. But we know that the investor have a lot of behavioral biases, particularly in the downside. When people are facing the loss, we have a loss aversion. And there's a particular phenomenon we call dispositioning effect. So when there's information coming there and people get really overreact in the downside. So usually they are selling too fast and they are holding too long. So this particular strategy is utilize that using this disposition effect. Particularly that we use that one to create an index and to select the stocks they have least possibility that will have an impact from this of the disposition, and then laterally have the rebound from that.
Okay, so it's rules-based, and it looks for it objectively on what is most dispositioned and what's right for rebound. What kind of signals does your algorithm, does your ratio pick up when stock prices are just kind of drifting higher, melting up, indexes are making new highs, like we've seen the last few weeks?
Yeah, I mean, the index itself is based on the ratio, called Chow ratio. This ratio actually is the ratio between the return and the asymmetric volatility. So there's a way that I can measure the asymmetric volatility. The asymmetric volatility for the individual stocks provide a signaling that the stock actually have an overreaction.
Okay.
Yes.
Now, looking at U-Turn's risk-adjusted return, your Sharpe ratio is 1.26, just slightly lower than USMV, which is about 1.3 or so. You claim your ETF is the new school low volatility. What do you mean by that? Explain that.
Okay. The volatility, the conventional viewpoint, is the variation of the symmetrical gain and loss. However, in reality, we are facing a lot is asymmetric gain and loss. So the algorithm I developed here is really try to protect downside based on the asymmetric volatility. So this is a new approach. Nobody actually used that before.
You talk about you're looking at behavior of investors and kind of capitalizing off of that. We know that there are algorithms linked to President Trump's tweets and subsequent pullbacks that we've seen in the markets as a result. So how does your ETF factor in tweets and the knee-jerk reaction that we get?
We don't actually pretty much to quantify the information, but it's based on the some kind of mathematical algorithm. We can see that the asymmetry in the volatility sense, and they're usually caused by those information bias. We have actually some analysis find out the Chow ratio is pretty robust, especially the time when President Trump had tweets. We see that the Chow ratio really pick up the stock, which has actually better performance during that period of time.
Oh, interesting. Okay. In terms of turnover, U-Turn has incredibly high turnover. It replaces its entire portfolio pretty much every week, which crushes the annual fund turnover record for any equity ETF. I mean, look at that, 3,300%. Yeah. High turnover is not necessarily seen as a great thing in the ETF world.
Yeah. I think in our, we have different philosophy, okay? The ETF or U-Turn X is the index. It's designing is to try to minimizing the downside risk exposure. So it's more like a hedge fund. So in order to do the hedge, you have to have a frequent rebalance. Now we are comparing the trading costs versus hedging costs. So the trading cost actually is declining over time, but the hedging costs increase more and more. So comparing with these two, I don't think the huge turnover will affect the hedging behavior for this particular fund.
All right, very quickly, any of your students coming up with an algorithm or an index that we should be aware of?
Yeah, I have a few students work with me and together, and I wish to have more people can use this.
All right, so perhaps new active managers will be in Professor Chow's classes. Thank you so much, Professor Victor Chow of West Virginia University and Senior Investment Consultant to Vesper Capital Management.
Thank you.
Now, coming up, we take a sip of one ETF that tracks the price of coffee as prices bounce back in November. And for a drill down into all of Bloomberg's ETF content, you'll want to check out bloomberg.com/markets/ETFs. This is ETF IQ. I'm Scarlet. This is ETF IQ. For every ETF that offers exposure to an asset class or strategy, others are usually quick to follow. When you want cash, ultra short-term debt is one way to go. Insurance company Blue Cross and Blue Shield of Minnesota needed access to cash and created an ETF for it. John Orner is CEO and president of Aware Asset Management. It's an investment unit of Blue Cross and Blue Shield of Minnesota. But before we talk to him, Eric Balchunas is going to give us the drill down into the firm's fund, AWTM.
Thank you, Scarlet. Yeah, this is one of a growing category, which is ultra-short debt ETFs that are actively managed, right? The goal here is to be boring, but then try to squeeze out a little extra yield and return by going into corporates and maybe international, right? I sometimes refer to them as money market funds with a little kick, right? So here's the $300 million. A lot of that is from the insurance company itself, but that's pretty big. 23 is pretty cheap. Mint, the big competitor, is about double, I think, somewhere in the ballpark, maybe 35. So it's on the cheaper side. Let's look at what it holds, the cross-section of it. And you can see it's not a money market fund, right? It's not just treasuries. You're going to have corporates, mortgages, right? Over here, you're going to have maybe not everything in the U.S., and then you can see the big difference of sectors in different areas. And look at here, triple B. Again, it's not all double A, right? So you're going for a little extra juice, but the duration is going for under a year. So again, not much rate risk. Let's look at the return of this one versus the two big guys in the area, Mint and Near. And you can see it's very close, although I got to give AWTM the credit. It's edging it out, probably because it has a little extra triple B. That's probably where that's coming from. So look, I mean, this is a popular area, I think, for people who look to manage cash but get a little extra yield. This will work well.
All right, still with us right now is John Orner of Aware Asset Management. There's some 16 ETFs with similar strategies, including Bill, SHV, Mint. Eric named a couple of them. Why not just put your cash in one of those ETFs instead of doing all the legwork and create your own ETF? Because that in itself costs money.
Absolutely. Well, it is a crowded area. And we just felt within the Blue Cross Blue Shield system that ultimately we could do a bit better job of this. So as Eric mentioned, there's plenty of ETFs that are in that space. There's also other products. There's money markets, there's mutual funds, there's bank deposits. So we just felt that by better executing, we can add a lot more value to that short end of the curve. We all know that that's a constrained area. We all know that that is absolutely continuing to be a challenge for short-term cash. And by doing what we do and as efficiently as we do, that's where we add the extra value.
And here's a list of the biggest actively managed short duration. This is your competition, basically. Take Mint and JPST, or let's just start with Mint. How are you different? Like, what would be the case that, what are you doing a little differently than Mint?
Well, I can't share all of our secrets, right? But I'll certainly share with you that, you know, we're nimble, we're fleet of foot, and we're able to actually find inventory and source inventory in spaces that ultimately these organizations maybe don't even look at. So we're ultimately looking at that, we're adding additional value to each trade. You line up several of those into a portfolio, and you start to see the product that we have today.
And you know, you're an insurance company. When I wrote this book about how institutions use ETFs, one of the things in the insurance area was that there's NAIC
correct
accreditation, and they were giving all fixed income ETFs like the equity tag, and therefore insurance companies had an artificial barrier to investing in them. Can you just explain if this one's like that or how things are changing on that front?
It's a great point. We have an NAIC rating of 2. And through the National Association of Insurance Commissioners, that's a really low risk charge. And so when you're managing constrained assets like we do, like most insurance companies do, keep in mind it's not just healthcare portfolios, it's life insurance portfolios, it's long-term care portfolios, it's health savings account portfolios. That extra kicker, without giving up a risk charge on the front end, allows you to save that risk budget for later, more intermediate and long-term mandates.
Now, talk a little bit overall about insurance companies and their usage of ETFs. There was a study done by Greenwich not so long ago, which found 61% of insurers plan to increase their usage of these products, of ETFs. What are insurers currently using ETFs for, and how do you see them changing that up in the coming years?
Absolutely. I think they're being used for a whole host of items across the entire investment portfolio. I think they're generally being used for placeholders, if you will, in a lot of cases. With AWTM, we're not just a buy and hold, but we're also can be used for a liquidity facility as well, given the yield component. I think that's going to change. I think investment policies through these larger organizations, insurance companies in particular, will start to accept ETFs as a very viable product in their overall investment policy itself.
Got it. So Aware spotted a problem and found a solution and brought their own assets. This is the classic case of bring your own assets.
Yeah, and I don't shame BYOA. I mean, it gives you a base, and then anything on top of that's gravy. But you were trying to you were trying to get other people to go into it, right? You're not just like this private thing for your own insurance company, right?
Absolutely, yes. This is open to really any organization that wants to buy into AWTM. This is out there as a retail component. It's out there as an institutional investor product as well. So we plan on growing this in leaps and bounds.
All right. John Orner of Aware Asset Management, thank you so much.
Absolutely.
A unit of Blue Cross Blue Shield of Minnesota. Now, in this week's There's an ETF for That, we highlight a fund that's been a volatile brew for investors. Rather than wake up and smell the coffee, investors can wake up and get exposure to coffee prices through the iPath Series B Bloomberg Coffee Subindex Total Return ETN. It's a long name with a short ticker, Joe. The note tracks an index that serves a cup of a single coffee futures at a time, purchased 2 or 3 months out and then held until the month of maturity. Coffee futures have been on a multi-year grind lower because of a stronger dollar and higher levels of production. Futures for Arabica coffee, the variety favored by Starbucks, have dripped lower by 20% since January 2018, taking Joe along with it. In the past month, however, coffee futures appear to have bottomed out because of adverse weather in Brazil, one of the world's top growers. Conditions ranging from dryness to hailstorms may reduce the country's harvest next year. As a result, futures jolted Joe, rebounding as much as 18%, trimming its 2019 losses. Joe has some $80 million in assets and costs 45 basis points. It gets a red light in the Bloomberg Intelligence traffic light system for the credit risk that investors assume and the potential for futures roll costs. It's got a memorable ticker, Joe, but there was another one that also tracked coffee called Cafe, but that's dead now.
Yeah, pretty good ticker there. Cafe is one of many dead ETFs. In fact, this year we saw the 1,000th ETF die. So the graveyard is getting bigger and bigger, although I think it's a good thing. You know, you want to get these low-traded products off the system. And look, the ETF market is pure capitalism. So, you know, the voters decide. So
if you can't make it, you should die, and you've got to prove yourself day in and day out.
In a short, yes.
All right, that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. From New York, this is Bloomberg.